is one of the 6 members of the executive board of the ECB. He was a governor of the Central Bank of Ireland, but also he's been a prolific academic. And what I can tell you is that while being at the board as an executive board, he's still very much into academic research. Is very much related to current research. He follows, in particular, what we do at CEPR. I know he used to be a program director in the International Macro and Finance meeting, and is a great reference to see this link between research and policy. And I have very high expectations for your talk, Philip. And the title is about the Laboratory for International Macroeconomic Research. So you have up to 50 minutes, and hopefully then there will be time for questions.
Okay, thank you, Philippe. So I'll just wait for my slide deck to be shared. Okay, so we could just stay on that title page for a moment. So I'm very pleased to have accepted this invitation, even though, of course, I regret not being able to come to a physical meeting in Stockholm. So, of course, the original plan was for all of us to meet in Stockholm. And, of course, it brings together 3 of my favorite organizations, CEPR, as Philippe indicated. I think CEBRA has been a fantastic innovation to have CEBRA now as a focus for central bank researchers. It's proven to be very successful in the recent years. And then the Riksbank. Myself and Philippe were interacting a few days ago, and recalling for me my 2007 working paper in the Riksbank series about the krona and the external balance of Sweden. But I thought, in terms of picking a topic for today, it's useful to maybe stop every so often and think about the fact that the euro area really is a laboratory for international macro research. And I think of that for 2 reasons. One is, if you're a researcher interested in the global economy, the euro area, is a big block in any global economy model. So understanding the euro area and the linkages between the euro area and the rest of the world is very important for a major ambition in terms of international macro research, which is to have a kind of integrated view of the global economy. Second, but I think the second dimension is also important, which is the euro area has 19 member states, and this is unique. It's unique to have 19 member states with a common currency and a common central bank. And that really creates a laboratory for research, especially if you accept the basic idea that, we think the dominant motivation for the actual decision to launch the euro had a very big political component. So to the extent there was a political non-macro reason to launch the euro, then it very much has a very much some element of a exogenous component, which is very interesting from an identification point of view. It's so hard to do identification in macro, but with the elimination of national currencies, that within the euro area, that can really, I think, help to illustrate some basic mechanisms. By the way, on that, it also, I think, very much is aligned with, the trend in research in the US data as well, which is to more focus on regional macro. That we can learn a lot by looking at the macro dynamics state by state, region by region, in addition to just focusing on the national data. And of course, also in the euro area, that there's all sorts of interesting cross-border issues, whether in terms of trade or whether in terms of international financial flows. So, I'm just going to try and pick and choose a little bit, a little bit absorbing how I spend my days here at the ECB, and try and maybe highlight a few features that might provide some stimulus for academic research. Okay, so if you go to the next slide, please. So really, that's it. I'm going to have two sections to this. One is the intersection of the euro area and the wider world economy, and then zero in on looking inside the euro area at country dynamics and cross-border dynamics in particular. Okay, next slide. So of course, at one level, you can think about a long set of issues about how to think about the spillovers between the euro area and the rest of the world. Of course, there's also knowledge spillovers, and for that matter, monetary policy spillovers. But you can also very much think about trade channels and finance channels. And one important issue then in terms of modeling that is the role of currency. So the currency denomination of trade, in what currency exports and imports are priced. That's a very important issue. We know in specifying a macro model, but also in finance, we know there's a very sharp distinction in many models between domestic currency debt and foreign currency debt. So the role of the euro in terms of as a currency, in terms of the currency denomination of international finance is important. After that, I'm just going to say a little bit about one of the key characteristics of the euro area has been this persistent current account surplus. And without trying to dig into the origins of that, I want to make a connection between that long-running trade surplus and the inflation outcomes in the euro area. And then finally, I'm not going to talk about it today, but I would advertise 2 or 3 years ago now that there is a very nice global model at the ECB. So if you're trying to look at, well, how does the ECB try and model the global economy? This is a semi-structural model, but I think it proves useful on a regular basis for thinking about global economic issues. So I would say if you're interested in global models, you should take a look at the ECB variant of that. Okay, next slide. Okay, so it's also important, I think, always to be a little bit quantitative about this. So you can look at this slide in 2 ways. So this is the euro area share of global GDP. So one way to think about it is the inverse, which is the rest of the world is a rising share in global GDP. And so from the ECB point of view, modeling the rest of the world, understanding what's going on in the rest of the world is increasingly important in understanding the drivers of the euro area economy. It's just this is share of GDP, but if you think about share of world trade, et cetera, there's going to be something similar. So it's so important from our point of view to really take a global view of what's going on. The euro area really has to pay attention. But equally, for any other part of the world, even now, the euro area is about 15% of global GDP. So if you're going to write a global model, you're going to want to have a block for the euro area. It's a big enough fraction of the world GDP still that's very important for anyone understanding the world economy to have an explicit euro area block. Okay, and next slide. Okay, so the first topic, and again, there's no particular order of importance to how I'm touring around these different topics. But one topic is going to be the pricing of exports and imports. Now, at one level, that's relevant, purely and simply in terms of the euro area. So when euro area, so whether inside the euro area trade, I mean, often that's taken for granted, and it's pretty universal that all trade inside the euro area is going to be denominated in euro. So a large fraction, given that the euro area internal trade is a large fraction of trade for each member country, it's going to be the case the euro is the dominant currency for individual euro area countries. But even when you think about the relationship between the euro area and the rest of the world, it's going to be the case that the euro is very important. So this is coming, by the way, from a paper that came out, I think, in August, which is a joint project between the ECB, the IMF, and the Central Bank of Colombia, which again, if you're interested in these questions about the currency denomination of trade, I think is an important new data set, or updated and expanded data set. And what this tells you is, if you take the left side, that globally, well, and when I say globally, I mean the sample in this paper. Of course, there's some data gaps. Globally, the euro area, the world is, including the euro area, is exporting about 35% of world exports go to the euro area, which is the blue line. But what you see on the right side is the euro area is, I think, about 46% of world exports is denominated in euro. So the euro has a bigger share in the currency denomination of trade than it has in its actual trade share. So that's one way to convey that the euro is more important than simply the trade share. It is the case the euro is, to some extent, an international currency. So, of course, we don't disagree, and we allow for it in our own modeling, that the dollar remains by far the most important international currency. But it's important, at least for some parts of the world economy, to think about the role of the euro. By the way, in the right panel, when you look at the share of the dollar in the denomination of world exports, you see it's about 40%, whereas the share of the US in trade is only about 10%. So that conveys the importance of the dollar as a dominant currency. But I would note again, if you're trying to write a model, the role of commodities, because of course oil is priced in dollars, for example, and other commodities. So the red line is the share of dollars in non-commodity exports, and of course it's still a very dominant role, but it's not the case that it's disproportionately in commodities. Okay, next slide. Okay, you'll have to go to the paper and zoom in because it's too much to read here. But what this section of this new invoicing study looks at is basically Central Eastern Europe. And one of the messages here, again, going back to the idea of the euro as a innovation or a laboratory experiment, is because many models which correctly have a lot of persistence in invoicing behavior. So there's a kind of a norm is built in. If you've always priced in dollars, you're going to continue pricing in dollars. But what you see, at least in Central and Eastern Europe, is there have been movements away from dollar pricing to euro pricing over time. And that kind of connects to this basic idea that it's not the case that these invoicing patterns are necessarily locked in forever. And it is possible to see changes at certain points in time. And also, maybe the other point to make here is for these countries, by and large, again, there's definitely the international role for the euro. I mean, maybe one way to say that, if you think some of these smaller Central Eastern European countries, if they're exporting to a third country, so not, outside of the euro area, rather than invoicing in their local currency, they may invoice in euro, which again, compared to invoicing in dollars, may be a reasonable outcome. Okay, next slide. And then, actually, let me jump over this. I mean, this is just maybe making a similar point in terms of importing behavior. But I think it's qualitatively the same point, even though I think, by the way, there are differences between imports and exports. But if we go to the next slide. Okay, so then, I think what I just showed you were a collection of small Central Eastern European countries. But what's interesting was when you take the mid-size European, non-Euro area European countries, UK, Denmark, and Sweden, you can see, if you like, for these countries, a lot of their trade is denominated in euro. Now, the euro area is a big part of their trade. But what's interesting, because you might think if you're modeling a mid-sized country, why is it the case, for example, a UK firm is denominating its trade in euro, not sterling? Now, these are mid-sized compared to the size of the euro area. Maybe it becomes obvious that, you know, if you're going to trade vis-a-vis the euro area, maybe you're going to price in euro, because that's one of, again, in many models, if there's a big asymmetry between a smaller country and a larger country. But it's, you know, it's a feature that's not present in many models, that essentially these countries are pricing in euro, at the very least in terms of trading with the euro area. So it's an interesting feature. It was a feature, by the way, in some of the 1990s work, a prediction that once the euro was formed, some countries may switch their invoicing behavior. Okay, next slide. Okay, so the only point I want to make notice here, it goes back to the first point I made, is quantitatively, the rest of the world is important for the euro area. So in projections these days, there's a big drop in foreign demand facing the euro area because of the global pandemic. So we are modeling, and the IMF is modeling, a significant drop. In the footnote there, you say, you know, it's around nearly 10% foreign demand shock to the euro area in the July IMF WEO update. But in terms of GDP, what you see is that this is non-trivial. It's if you just model the direct effect of a trade shock, it's about 1.5 percentage points. So that's one point to make, is the rest of the world is important, quantitatively important for thinking about euro area GDP. And then the right side is the total effect, because the other point in thinking about this is to recognize the importance of basically input-output linkages within the euro area. So once you allow for the fact that trade shocks tend to be amplified through supply chains, then the overall effect is actually amplified, and we get an overall shock more like 2 percentage points. So I'll come back to that point about amplification of trade shocks in a few minutes. But I think, again, quantitatively, it's important to think of the euro area as being quite involved in global trade. Okay, next slide. Okay, now having talked a little bit, just in a cursory way, about the currency denomination of trade, I want to switch to the currency denomination of international financial flows. So again, this reflects a new data set, which again is a joint work between the ECB and the IMF, and in fact is actually providing an expansion, quality improvement and update on the work I did with Jay Shambaugh 10 years ago. So it's basically trying to work out the currency composition of the international balance sheet. And here, you know, in that work, we developed various types of indices to capture the foreign currency exposures. And this graph is qualitatively similar to what we found 10 years ago, which from the 1990s onwards, whether you talk about advanced economies or emerging economies, there's been a rightward shift in the distribution, i.e. more and more countries are net long foreign currency, and fewer countries have serious net short foreign currency positions. So if you recall, a lot of studies in the 1990s were concerned about foreign currency debt. But of course, with the accumulation of reserves and the building up of domestic currency debt markets, the quantitative nature of foreign currency exposure has changed. Next slide. And this is just a different way. This is a different scaling factor, which is +1 to -1, but making the same point. But maybe if you look at the right side, because of course you can argue about what does it mean to have currency denomination of equity and FDI. If you focus on currency denomination of debt on the right side, what you see for the euro area is, again, if you go back to pre-euro times, on net, the euro area was short foreign currency. Because remember, there were quite a number of euro area countries which might have borrowed in Deutschmarks rather than they were local currency. So, I mean, I know for sure in the Irish case, a lot of Irish sovereign debt in the early 90s would have been in Deutschmark. So with the formation of the euro, by and large, the foreign currency exposures of euro area countries are basically at zero now, because all of their, it's not all, but a very high fraction of the foreign currency debt, of the debt positions of the euro area countries are in euro. And again, you might not be super impressed by that. But again, in terms of thinking of the long-term evolution of some of these economies, the fact that debt is in domestic currency, in euro currency, is I think, quite relevant. Okay, next slide. And again, there's other ways to show that. Actually, I'll skip to the next slide. This is all instruments, but debt is more interesting. So what you see here is the split between domestic currency and foreign currency in terms of the debt assets and liabilities of different countries. And what you see is, again, if you go to 1994 pre-euro, a lot of the, on the liability side, the debt liabilities of euro area countries were in foreign currency. So only about 20% were in domestic currency. After the euro, so whether it's 04, the big change was the formation of the euro. But even going to 2017, it's now more like nearly 80%. So most euro area residents issue debt in euro when they're issuing to foreign investors. So again, in terms of the dynamics of lots of models, that's a very basic fact to keep in mind. Of course, on the asset side, it's a lot of the assets of euro area residents are in other euro area countries, and I'll come back to that. So the picture is actually reasonably similar on the buying debt assets as well. Okay, next slide. And then maybe I just wanted to throw this one in, especially in this year now when we're going to have a lot more supranational debt. So with the EU Recovery Fund, the SURE Fund, and so on, we know supranational debt, i.e. debt issued by the European institutions, is getting more important. So this is from an older study, but I think the basic point that holds true is when we think about global investors, they are disproportionately interested in supranational debt. So half the supranational debt, like the ESM bonds and so on, issued are bought by non-euro area investors. So this kind of global positioning where non-euro area investors are very interested in supranational debt is in this high-level task force on safe assets, which this graph is from. We go into that a bit more, but it's an interesting stylized fact when you're trying to think about the nature of supranational debt, in the coming years. Okay, so next slide. Okay, now again, this is in my kind of racing around different topics. I just want to make a couple of comments about the intersection between quantitative easing and portfolio flows. So what you see here, this is the portfolio investment abroad, i.e. euro area residents investing overseas. And what you see here is a fairly strong correlation between quantitative easing and foreign portfolio investment. So again, when you're trying to think about how do portfolios rebalance when the central bank buys up sovereign debt and corporate debt or whatever, this cross-border dimension is relevant. So I don't want to dwell on this point for now, but again, in terms of topic areas, the kind of cross-border dimension is relevant. Okay, next slide. And equally, on the other side is when there's the opposite correlation, if you like, comes from foreign investors in the euro area. So when the central bank steps in, foreign investors tend to change their behavior as well. So again, in any research on quantitative easing, it's not just an issue about understanding how domestic residents respond. It's also important to think about how global investors respond. Okay, next slide. Okay, now I just want to switch to this topic about the euro area current account. Now, in a little bit, I'll talk about current account balances on a country-by-country basis. But from a kind of macro point of view, it's also relevant to think about the euro area current account balance. And what you see here is basically two phases. Is you had a phase from the early 2000s until the crisis, where the aggregate current account was more or less at zero or slightly dipped negative. And then post-crisis, we've had this persistent increase movement into surplus. Now, the surplus did shrink in the most recent period, but by and large, you can think of that as two periods. A period where the current account was more or less at zero or slightly negative versus a substantial positive balance. Now, if you get behind that, what you actually see is in the first decade of the euro, you had a mix of surplus countries and deficit countries. We know that, and I'll come back to that. After the financial crisis over the last decade, more or less, we haven't seen too many countries running material deficits, but we still have more countries running surpluses. So that's the mechanic behind this. Now, of course, in many models, the current account and the net IIP plays all sorts of roles. If you go to the next slide. And by the way, what used to be a little bit of a puzzle in the data is disappearing, which is since 2014 onwards, the current account surplus is also mapped into an improving net IIP. That's relevant because for a few years, there was a bit of a divergence between the net IIP and the current account, which of course goes to issues about stock flow adjustments and valuation effects and so on. But in the last number of years, there's a stronger correlation between the current account and the net IIP. Okay, so there's lots of issues there, but let me highlight one area which may not be so obvious in the next slide. And this is a lurking correlation between the trade balance and the inflation rate. Now, this is not something I've seen too many papers about. So there's one paper a good number of years ago by Ferrero, Gertler, and Svensson, Mark Gertler, Lars Svensson, and Andrea Ferrero. So there is an interesting paper for those who think, well, how do I think about the connection between the trade balance and inflation? So it's, or more directly, monetary policy. But it is a striking feature in this time period when you're trying to understand low inflation. Is there a connection somehow between the persistent trade surplus and the persistence of low inflation? I'm not saying I have an exact answer, but quite often in many closed economy, by definition, a closed economy model, there's no difference between output and expenditure, or income and expenditure. So in other words, you might say, well, I'm going to have a model of inflation where we look at the output gap. But if you look at the output gap, you might say, well, your area GDP recovered quite a bit in some recent years before the pandemic, and therefore you might see more inflation pressure. But if you're running a big current account surplus, the translation of higher output into more expenditure is broken to some extent. And that is interesting in a world where we think the wage Phillips curve is more robust than the price Phillips curve. So what determines pricing behavior? And again, it's more of an invitation for research than anything else. I mean, there is a relevant issue about any low inflation theory interacts with the, of course, the asymmetry where negative shocks to inflation are more likely to be visible in the data because we're at lower bound issues. The level of aggression in clearing up negative shocks to inflation is going to be different to positive shocks to inflation. Okay, next slide. So in this paper, I was involved with a group of ECB co-authors where, which I think was actually a CEBRA event last year, well, with money market finance anyway, where we tried to do a survey or kind of up-to-date explanation of how the Phillips curve is used at the ECB. So the Phillips curve has both kind of structural versions. So Phillips curve type equations are in all sorts of structural models at the ECB. But it's also, in terms of the empirical level, it's one kind of reduced form empirical technique that is used. Now, what's interesting though is when you try and look at versions where you're actually trying to have a forecast equation for inflation. Let me work from the right to the left here. So let's say you have an unemployment-based measure of slack. And then you ask, well, is that enough, or should we think about the rest of the world? And if we throw in some kind of import price index or other kind of price-based index, would the forecast error be reduced by allowing for other influences, which again we think it might be influencing pricing behavior? And by and large, there is a contribution from including various indices of external price pressure. But empirically, adding in the trade balance has a bigger effect. So because this runs with a whole family of different equations, so this is why there's a kind of a box plot type approach here. But if you look at the unemployment-based measure, the forecast error is a lot smaller when you include the trade balance. So again, I'm not saying of a theoretical explanation, but empirically allowing for the trade surplus seems to be and have some predictive power. In the middle panel, we look at other output gap measures, and again, qualitatively, directionally, including the trade balance does seem to have some ability to improve the inflation forecast. The left panel, the differential is smaller because this work by Jarosinski and Michele Lenza already has imports and exports in their output gap measure. So there's maybe a little bit of the contributions already there. Okay, so again, I'm hoping to outsource some interesting inflation research to the academic community here. Is you explain to me, is this apparent, or is it an interesting substantive reason why the trade balance may play a role in inflation dynamics? Okay, next slide. Okay, now I come to the second topic, which is trying to think about the euro area from a point of view of the 19 member states. What does it mean to have a common currency? How does that influence national macro outcomes? I mean, I read all sorts of papers where country level data is included from euro area countries without allowing for the fact that these countries are at the very least clustered together because of the common currency. So you can think about country dynamics in the same way you can think about state level dynamics in the US data. But you can also think about cross-border. So what is special about cross-border dynamics in the euro area? Okay, if you move to the next slide. Now, again, I didn't try and do a comprehensive literature review, so apologies if I didn't cover any papers written by the audience today. But what I did want to highlight a little bit is some of the papers that I found directly relevant and interesting for some of the questions I face. And of course, I've already made the point, there's a lot of interesting work going on in terms of regional macro using the US states. So part of this, again, is again, we need to think about conceptual frameworks, theoretical models, because we do know that the single monetary policy, the ECB interacts with a lot of diversity across the euro area. So of course, this I use personally a lot, this AER paper by Philippe Martin and Thomas Philippon, which essentially is a very neat framework because it allows for macroprudential policy at the national level. And you can see how outcomes are so different when you have active macroprudential policy and also countercyclical fiscal policy at the national level. The survey paper by Marcus and Ricardo, I would, again, advertise because it really helps to kind of convert everything about the euro area crises into interesting theoretical questions. Then something that, of course, has been relevant this year and also relevant in previous crises is rollover risk. So what, is the case rollover risk more severe in a common currency area? So this work by Bianchi and Mondragon is, I think, a very, very, nuanced and I think a convincing way to model the interaction between rollover risk, real exchange rate adjustment, and so on in a common currency area. And then in terms of, the euro area architecture has changed. We now have the ESM. We now have a track record of official funding within the euro area. So again, Pierre-Olivier, Philippe, and Todd Messer have this, I think, interesting work on bailouts in the euro area. Okay, so I think strongly advocate everyone to keep on working on that line of thinking, because again, the euro area is not a static concept. The euro area architecture now is very different to 20 years ago, but also at an empirical level, I suppose, more reflecting and more directly my own background, the fact that we've eliminated national currencies and national monetary policies does shed some light. So there's an AER paper by Burka, Devereux, and Engel, which says, well, if you eliminate the noise of national currencies, maybe some of the drivers of real exchange rates would be more visible in the data. And what they find is a kind of stronger visibility of the relationship between relative productivity and real exchange rates. So one of the basic Balassa-Samuelson mechanisms. And then with Livio Straka, we have this paper where we essentially argue, at least for the smaller euro area countries, the external value of the euro, the euro dollar rate, for example, can be viewed as an exogenous shock. So if you try to understand, well, how do exchange rates affect individual member countries, that technique, I think, can be interesting to some extent. Okay, next slide. Okay, this goes back to what I showed earlier on, is basically this idea that, so earlier on I showed you the impact of external shock, so rest of world shock on the euro area. Here, I'm going to make the same point, which is another feature of the euro area, which is maybe underemphasized, is the very strong, at this point, production linkages across the euro area countries. So if there's shock to any country, if there's shock to Germany, to the Netherlands, whatever, there's a significant transmission to the rest of the euro area. Where here in this work by Virginia Nino and Veltri, there's this decomposition between demand side linkages and supply side linkages. But what essentially shows you in percentage terms, if there's a shock in Germany, there's nearly a 20% spillover to the rest of the euro area. If there's shock in the Netherlands, there's a bigger spillover in a ratio sense, because the Netherlands has such a trading nation. So I think, again, if you try to think about dynamics of trade shocks and so on, this integration within the euro area is quite important and something we look at quite a bit. Okay, next slide. Okay, so let me come back to real exchange rate adjustment inside the euro area. because of course, it's always important that when we think about real exchange rates for individual euro area countries to recognize there are two components. Here I'm going to look at the inflation differential within the euro area. This is important, and I'm going to spend a minute on it. But what I'm not going to show you now, but which is also very important, is of course the external value of the euro. All member countries have a lot of trade with the rest of the world. So when you think about the trade-weighted real exchange rate for any individual member country, the external value of the euro against the dollar, against other currencies is going to be very important. So I wouldn't solely focus on the inflation differential as the way real exchange rates move over time, because the external value is also important. Having said that, it's important to think about the role of real exchange rates inside the euro area. So in the first decade, the left panel shows in the first decade, we have this strong correlation between large current account deficits and positive inflation differentials. So lines of causality probably in both directions, but it's an empirical fact that those countries that had large current account deficits had higher inflation rates than the other countries. Then in the middle, we see, well, okay, we had the sudden stop of the 08, 09, the sudden stop of the global financial crisis. And by and large, we had a degree of reversion. So if you're running positive inflation differential beforehand, there was a move to a more less positive or even negative inflation differential after the crisis. So real exchange rates did adjust to some extent. But what you see on the right panel is a lot of the adjustment was by quantities. You had this correlation is very strong in terms of surges in unemployment being associated with lower inflation differentials. So this does indicate that you can draw many lessons from this. You might look at the middle panel and say, look, real exchange rates did adjust to some extent. But if you look at the right panel, you might say, well, at the very least, not perfectly or with a lot of pain, which underscores the importance of allowing, for example, downward nominal wage rigidity in the models. I mean, it's very hard to explain that pattern unless you have a fair degree of nominal rigidities. So that's an important modeling choice. Of course, it does say, let's not, preemptively, if we can avoid having really large imbalances, that can help also. Okay, next slide. Okay, so one of the interesting uses of national data is, and this, by the way, is very much connected to some work I think that has happened in US data, using state level data to try and more identify the Phillips curve. So what I have here is, if you just run euro area aggregate data, is you get a, and again, I'm being super casual here, and this is just the empirical reduced form Phillips curve. It's not the structural Phillips curve. Is what you get here is a coefficient, if you use the app gap of 0.008, unemployment rate 0.01. So it's there, it's significant. We might say it's fairly flat. Now, as Silvana Tenreo and her co-authors have emphasized, you have a fundamental identification issue here, of course, which is if you respond to bad news by easing monetary policy, you're going to get a flattening of the empirical Phillips curve, even if the structural Phillips curve is steep, because monetary policy is responding. So in terms of trying to understand the structural Phillips curve, that's going to be not true at the national level, because at the national level, controlling for common factors, we don't have a monetary policy response. So eliminating the endogeneity of monetary policy to the output gap or other indicators of macro variables can shed some light. So in the next slide, what you see here is you get bigger coefficients. So this is either pooled or fixed effects and time effects. If you pool the individual euro area member countries, the relationship between the output gap and inflation at the national level is a lot tighter. So again, I think that this is one interesting way you can use the fact we have 19 countries and a single monetary policy to learn something about the underlying behavior of the economy. Okay, next slide. Okay, let me now turn to the issue about understanding, if you like, divergence and fragmentation in the euro area. So what this slide shows you is the average sovereign yield in the euro area on a 10-year basis relative to the risk-free rate, the overnight index swap rate. So that's a natural way to think about what's going on with the cost of debt for sovereigns. And this is the GDP weighted average. So what you see, what happened this year is we had the increase, which peaked, sometime in May. Well, I mean, there's a peak pre-PEP, but once PEP came in, there was some correction, and then especially after the EU Recovery Fund became real, we've had this important decline in average sovereign yields. Now, next slide.
5 minutes.
Yeah, I'm coming to the end. The next slide shows you, of course, the contributions to that, which of course is a big decline in the spreads across the member countries, and also so that's I think quite important. So we have seen this compression of spreads this year. Okay, next slide. So let me emphasize here one way to think about that. Because of course you can just look at the yield data and make inferences, but it's also interesting to look at the BOP data, because of course the kind of conjecture that there was a flight to safety episode, because remember in the common currency, and this goes back to one of the fundamental characteristics of a common currency, if risk goes up, you can exit an individual country's securities without taking on currency risk. So that is not true for any other country. If I want to exit some Latin American country because my risk aversion's gone up, I have to take on some degree of currency risk to do so. In the euro area, the substitutability is bigger because of the common currency. And so let me focus on the liability side. And if you split the euro area into different groups, the less vulnerable countries, the more vulnerable countries, this year, what did you see? You saw that international investors wanted to hold more of the government debt of the less vulnerable countries. There was an inflow into the safer countries, if you like, the Germany, et cetera. So there was definitely a natural desire to hold more safe assets in this period. By contrast, if you look at the more vulnerable countries in the euro area, there's a fairly big outflow especially in March and April. So foreign investors were selling the government debt of the more vulnerable countries in the first months of the pandemic. But what's interesting is more recently that's gone away. So if you like, there has been a stabilization. This flight to safety episode, which basically saw a significant divergence in capital flows comparing the less vulnerable and more vulnerable countries, has gone away, which is very different to what happened in the 2010 to 2012 period. So we've had a kind of, if you like, a shock, a flight to safety shock, but in fact it was quite contained. And again, I'm sure papers will be written about the origins of that and the role of different policies to that outcome. Okay, next slide. Okay, so I think in the interest of time, I mean, this is just drilling into the role of different sectors here and the role of banks versus other investors, but I don't think I need to dwell on that. So next slide. Well, in fact, that might be it. So, okay, so without trying to plan it exactly, I've covered, again, maybe in conclusion, all I wanted to do here was to highlight some of the features of the euro area data, maybe in a direction of trying to suggest ideas for research, whether by academics or central bank researchers. Okay, so let me stop there.
Thanks a lot, Philip. Thanks for this great review of both interesting topics or interesting issues in the euro area, but also potential research topics. Hopefully, many people will pick up on this.